So excited to welcome you all to another episode of Together We Learn. There's a lot of interesting things that is coming out of Together We Learn. I am very excited to announce something next week. I'm not going to tell it now, but we want this to be provided to multiple people, and we're bringing a shorter version of Together We Learn, right? And today, what we're going to do is a second part to what we did last week, which is initial public offering. And like we all know by now, Together We Learn is all about how our internal team started learning about the world of economics and finance. And then we started realizing that most of the people out there, right, who was watching us today, they all also want to learn something new. So that's how Together We Learn kind of formulated. Now, this is run by the team at Vite. Vite is a financial wellness platform where we take an individual's financial decision to be very, very important. So we help them take those decisions in the right manner. That's what we predominantly do here. We kind of specialize in financial planning. That's our priority, or that's our sweet spot compared to most of our competitors out there. All right, so let's just quickly jump in, have a quick recap of what we did last time, which is initial public offering part 1. So we spoke about what an IPO is, and most of us know about the term IPO, but we didn't know a lot about what really goes into it. Then we spoke about the eligibility criteria and the IPO process itself, right, which is super important, but it's more from a perspective of what the company might end up doing, right? And then we came into the concept of the kind of stakeholders who are involved in it, right? So these are the different things that we spoke last week. And if you want to check out the video, link is down below, so you can always check that out. And from there, we also spoke about the pricing. How does the IPO pricing actually happen? Which is quite interesting because we all end up knowing the value, but we don't know how the value is derived at, right? So let's all be informed before we take a decision there, right? Now, from there, now we're going to jump into valuation. Valuation here does not mean how the company is being valuated by external parties. I'm talking about us as individuals. What kind of steps do we need to take to kind of value that company? So that's kind of super important for us to kind of take that decision. So the first thing that people actually take into consideration, or we should take into consideration, and one of the most popular ones, is absolute valuation, where we take the intrinsic value of the company. For instance, the true value of what that company would hold. And I'll give you a small example. I'm not going to jump into the details as to how we can do it, because I would like to do that as a separate session altogether for whoever's interested. Now, coming into a quick example. So Adani was trading when they went IPO. They said they're trading today at 3,000 rupees per share back then, right? But the true value of that particular stock or that share was only 900 rupees. So that's something that we have to look into, and how we look into is different valuation techniques. So one could be that like discounted cash flow. Another one could be dividend method. So these are the different methods or models in which we have to do that. I've just mentioned like a couple of them, but there are a lot more that is available out there, right? The next important one is relative valuation. Like the term, it basically means comparison. So it's nothing but we look into the PE ratio of the companies in the sector. So let's take an example of Cognizant and Infosys. So these two companies are within the IT sector. So we'll take the IT sector's PE ratio and then compare it against the PE ratio of this particular company which is coming IPO, right? If it's low, then accordingly we take a decision. If it's high, we accordingly take decisions, right? Pretty much when it's low, it's always good, because like there was another video about PE ratios where you understand how you should select good stocks. So in that we talk about more about the PE ratio and why that is one of the main reasons why people consider like before they take a decision like PE ratio, or before taking a decision like selecting a stock, right? The final one is economic valuation method. It's nothing but looking into the assets and liabilities of a company. It's pretty much not that popular in the market today as retailers for us to look into, because it's a lot more technical, a lot more difficult for us to do, right? So these are the 3 different methods that we as individuals can look at, and we're going to deep dive into them later in the Together We Learn modules, but this is one of the few things that we want to quickly touch base on. Now, another important thing is, how are the IPO shares actually allotted, right? And definitely there's two different scenarios. Most of us would have heard these terms if we know what an IPO is, right? One is when it is undersubscribed, which means there is, for example, 100 crores is issued, but around 90 crores is only subscribed, which means everyone who is bid for it will get the allotment done. So they all will get their shares or IPOs allotted, right? Now, the other method is when it's oversubscribed. Like, for example, recently IdeaForge was oversubscribed. So if that happens, then it jumps into a lottery-based system where based on the lottery, random people would end up getting these IPOs allotted to them. So that's something that like people have to wait, and it's purely based on luck. Now, coming into IPO Watch, and why I want to talk about IPO Watch is mainly because, like I said, it is luck, but there are other ways in which people actually try to gain access to these IPOs. So one is gray market premium. So it's nothing but there is another market which is unregulated, which is a gray market, right? But most of the companies do want to play a role, or they want this market to exist because they can get a sense of how this IPO is going to go, right? So it's majorly like how polling happens before an election. It's quite similar to that. So in the gray market premium, what happens is, based, let's just say Rithwin, that is me, I buy 17 shares, which is one lot. If you remember from the previous part, you know that you can't buy individual shares. You have to buy a lot, right? Now, another individual called Shiva might end up saying that, hey, I would want to purchase like 2 shares, but I'm going to give you 20 rupees more than what you're going to buy it for, right? So in that case, if I get the allotment, if I get the IPO, if my application goes through, and if I get that, then that 2 shares I have to then give it to that particular individual, right? Now, the other way in which you can do it is you can sell the entire lot, right? Which is basically, I have 17 shares and Shiva is saying that, hey, I want to buy all the 17 shares. I want to buy your entire lot, right? So to buy this lot, there will be something called as caustic rate, which is nothing but whether it is allotted or not, I will get the money upfront, right? If it's not allotted, then unfortunately Shiva took that risk and it's up to him to do that. If it's allotted, then well and good, he gets what he wants. He also pays me upfront, right? The other within the same concept of buying this from the allotment, before the allotment, there is something called a subject to sawdown. So it's nothing but you will only give the money if the allotment actually happens. So you kind of formulate like the dealer would say that, hey, there is Shiva who's ready to buy it, but he'll only buy it if you get the allotment, if the IPO application passes through for you, right? So these are the 3 other ways in which IPOs can be done. So let's just say if you felt like IdeaForge is something that you weren't able to capitalize on, you could have gone to the gray market and then tried this particular strategy out, right? Because there are dealers and there are platforms who actually support this as well. Now, what is green shoe option? Which is quite interesting because, like I said earlier, most of us would have heard the word called oversubscribed, right? Which is when you're only issuing 100 crores worth of IPO, but then because of the demand, it probably 1,000 crores is what people have gone for, right? So which means only few people will end up getting that allotment done because there's a limited number of people who can get it. But what companies can do is they can go beyond that and raise up to 15% more, right? So if it's 100 crores, they can increase it to 115 crores after they even file for the initial IPO, right? And this has to happen within the IPO period itself, but they can go beyond that, right? So to give you an interesting example on this, recently Patanjali went for an FPO, which is basically a follow-on public offering. So once the IPO is done, the FPO will come. You can't do 2 times initial public offering, right? It doesn't make sense. So when that follow-on thing comes on, so what happened with Patanjali was that it got oversubscribed and they did have a green shoe option, but they didn't exercise it. They didn't use it, right? So what happens with green shoe is the moment you say you're going to give 15% more, what happens there is the entire stocks, because you're gonna give additional 15%, right? It kind of dilutes from the stakeholders. So it's very rare that people end up doing it, but there are still companies who might need more money, they might end up doing it as well. Now, coming back into another tabular column, and this is a very interesting tabular column because I want you guys to look at real data as to why IPOs and how IPOs are actually happening in the market, right? And why there is always a craze around it, because we all end up hearing it, but when most of us might not know how to act upon it, and then we miss out on it, right? So that's something that I want to quickly give you a heads up on. So if you see here, these are actually real-time data. The first two columns that you see, the Siachi and Paras Defense, are recent, whereas the other two are a little bit older. So if you look at Siachi, the offer price was at 163 rupees. This is what was offered by Siachi to the IPO subscribers, right? Now, on the day of listing, on the end of that day, it went up to 603, right? So people who ideally go into IPO, they're trying to maximize it because of that listing day bounce that it gets, right? Now, the gain was around 270%, and how much they actually issued was only 125 crores. But look at how much it was subscribed for. 12,782 crores. That's how much it was subscribed, which means it's oversubscribed, right? Now, similarly, Paras Defense and Space Technologies, at that point of time, there was some new regulations around, new policies around space technologies and defense, that it actually had a 185% increase, right? But the allotment size or the issue size was only 170 crores, right? But how much it was subscribed for was 41,960 crores. That's way beyond what it was, right? So that's something that you need to remember, that IPO does have a great side to it, and that's why people are attracted to it. But at the same time, it also has negative intonation. Everything has a good and a bad, isn't it? So if you look at the last 13 years of data, there were around 336 IPOs that went live. And if you look at that, around 43 of those companies don't exist anymore. They're gone, they're wiped out, right? And out of that, out of the 336, 182 companies are still trading below the listing day closing. So on the day of the listing, it's trading below that, right? 154 companies are trading above that, whereas 57 companies are trading with 90% loss. So an example of that would be like Paytm, right? They are going through a heavy loss. I don't know if it's exactly 90% at the moment, but it's definitely greater than 70%, because that's something that I remember reading like 2-3 months back. 7 companies are trading with profits greater than 1,000%, right? So that's the reality of what IPO is. There's a good and there's also a bad. Now, coming into the data that you see here, these are all the different IPOs that were issued from 1989 till 2022. And you can see the number of IPOs that were issued and then the amount itself. And you can see in the year 1994 to 1995, there was a lot of these, but then the issue size was only 12,000. Whereas in 2022, you can see there's only 56 IPOs that went live, but the value is crazy high. And then one of the reasons is because LIC went live during that time, right? So that these are the data that we would just want you to just consume, because they're quite interesting, and looking at data is something that we love doing down here. Now, 10 things that you should do before buying an IPO. I'm just going to list them down. Apart from valuation, valuation is also a point here, but I just want to list them down in an order so that you can start preparing, start taking more informed decisions rather than hastily doing something just because someone is also doing it, right? So first and foremost is, please read the red herring prospect. It is prospectus, which is nothing but an entire document which speaks about the inside out of how that company is running, right? So from there, also start knowing more about the business, which segment that they are in, etc. After that, look more into the company, who are the leadership team, what kind of decisions or what kind of trajectory that they have. Do they have a past history of taking the company from 0 to 100? Those kind of things are also very important. Apart from that, knowing about that market is also very, very important. Then also, please understand that every IPO has an IPO issue price, right? Because they're going to raise like 100 crores or 500 crores, right? Always try to understand how are they planning to utilize it. in the previous version, we spoke about offer to sale, right? And new sale, because that's something that you need to do. Please go check that out so you understand more about it. But that utilization is very important because you should know where this money is going to be deployed, right? And then apart from this, you should also know the key strengths of the company. Are they great with their sales team, or are they great as product companies because they have an amazing vision and they have a great team to execute that vision, right? And also know about the risk that is involved in that company. For example, let's just take an example of a company like Freshworks, right? Freshworks is into a help desk space, but they should know, or we as individuals should know, that there's so many other companies who are also playing in that same space, which is very important for us to realize and consume and take decisions based on that. Then comes the checking of the valuation of the company, right? Look at their financial statements, look at those 3 pointers that I said, 3 methods that we could use, 3 models that we could use. See that and understand how you can judge the company better, judge the company more informed, right? That's a better word to use here. And also, it's very important for you to know the kind of investment banker who's involved with them, right? Because every IPO before they go, they have to have an investment banker supporting them. It could be Axis Bank, or it could be let's just say Morgan Stanley, but understanding who they are and what kind of work they do, are they really good at what they do? These are things that is very important for us to understand before we take a decision. And then finally, this is more personal, the 10th point, understand how long you would want to invest in them. Is it just for you to just get that listing day profits? Is that something that you're looking at, or are you looking at it in a long-term perspective, right? So that's something that you need to realize, or at least start making a note of that mentally so that you can take actions based on that. All right. Now, this is a small gist or a picture of how a prospectus would look like, right? Again, I can't cut any of these things, but these are the amount of information that you get in the end of the day. And most of us, we think, okay, we don't have enough information. Only the investment bankers or the people with influence has these information. That's not true. All companies have to do this as part of SEBI regulations for them to do it, right? So please do check that out. Now, before we close down, you need to understand that before the stock goes live, before the IPO goes live, or when it gets listed, everything happens in the primary market, which is something that we spoke last time, where the company will issue it to shareholders, right? Or people like us who are planning to get that particular IPO listed for us. Now, once that is done, right, when it goes into the secondary market, the company is never involved. It's just between us. If I got the IPO listed and I got that allotment to my name, then I can sell it or I can buy it from someone else if I want to buy more shares of it, right? So that's something that you need to understand. These are fundamentals of how the market works today. If you have any questions, comments, feedback, please do share them. We're going to make an amazing retweet to what we are doing on YouTube, but at the same time, we're going to make shorter formats of TWL so that you understand them better and you can optimize on more learning in a very short span of time. That's something that we would love to do in the upcoming months. So thank you so much for watching, and please do subscribe and like the video, and do show us your encouragement because there's a lot of effort that is put into it for us to do this entire segment. So thank you so much.